Welcome to A Clinical Guide to the Markets, a work that bridges the philosophy of markets, medicine, and individual liberty. Written by Jean Jerome, RNBSN, RPHT, this guide applies the precision of clinical thinking to the art and science of trading. What you see on the left is a heartbeat, and on the right, a candlestick chart. They are telling the same story. Years spent watching the green lines of cardiac monitors trace the story of a human life in real time. A widened QRS complex or flattened T wave told me the body's internal economy was out of balance. A candlestick on a chart is nothing more than a vital sign. Context transforms data into understanding, and understanding transforms into action. Trading is not gambling. Trading is diagnosis. The economy is not a machine. It is the sum total of billions of purposeful human choices. Money evolved organically through voluntary interaction, not by decree, as the regression theorem explains. Every trade is an attempt to anticipate the future decisions of other participants, and artificially cheap credit creates malinvestment, the false boom, that inevitably leads to the bust. As Ludwig von Mises wrote in human action is purposeful behavior, the ego's meaningful response to stimuli. Behind every trade is an infrastructure that either works for you or against you. A dealing desk broker operates in contaminated order flow. It takes the other side of your trade, creating a structural conflict of interest where the broker profits when you lose, leading to stop hunting, spread widening, and requoting. An ECN or STP model, by contrast, routes your orders directly to global liquidity pools with complete alignment. The broker earns a flat commission and wants you to succeed, delivering transparent pricing and straight-through processing. In medicine, a well-perfused organ receives the oxygen it needs to survive. In markets, liquidity is the perfusion of capital. The London and New York overlap represents the power hours, where massive institutional volume floods the market, tightening spreads and producing clean, tradable moves. The Asian session, by contrast, is illiquid. High risk of slippage and erratic price gaps, the equivalent of a heartbeat skipping rhythms. Trading EUR/USD at midnight Eastern Standard Time is like performing surgery with half the nursing staff missing. Technically possible, highly inadvisable. Every candlestick is a complete story of a battle between buyers and sellers within a given time period. The doji, that's where open and close are identical with wicks on both ends, is an inconclusive test. The market is undecided, and it signals a potential reversal warning. The hammer, with its small body at the top and long lower wick, is the defibrillator. Sellers forced price down, but buyers absorbed the pressure and reclaimed the territory, battered but alive. Support and resistance are not arbitrary lines. They are the visible traces of institutional memory. When a floor gives way, the break is violent because cascading stop-loss orders act as fuel. Moving averages tell a different story. An SMA is the patient's medical history, while an EMA is the nurse's shift report. A golden cross signals short-term weather warming relative to the long-term climate, but remember, moving averages are lagging indicators to be used for confirmation, not prediction. Volume measures the intensity of conviction. A breakout on 3 times average volume is a high-conviction move backed by institutional capital, while a breakout on low volume is a false signal, a heart rate spike that returns to normal. As Raja Banks put it, clean your charts, simplify your mind. If you can't read the story the candles are telling you without 20 indicators, you're hiding from the market. Price action, support, and resistance. That is all you need. Inside every trader's brain, 2 systems are competing for control. The amygdala, the ancient sentinel, reacts to a red candle exactly like a physical predator, triggering adrenaline, narrowing focus, and prompting fight or flight, causing revenge trading, closing winners early, and the code blue panic. The prefrontal cortex, the seat of rational planning and probability, requires deliberate activation through memorized, structured protocols. And when engaged, it channels that same adrenaline into purposeful execution. 3 psychological enemies stand between you and consistent performance: fear, greed, and ego. The pain of loss is twice the pleasure of gain, and FOMO will pull you into trades that don't exist. Greed is stopping the medication early, taking profits prematurely, or risking too much after a win. Ego refuses to close a loser because it cannot tolerate being wrong, locking you into confirmation bias and the sunk cost fallacy. The gambler prays for luck and tries to be right. The clinician engineers an outcome and tries to execute the system. As Ed Seykota observed, win or lose, everybody gets what they want out of the market. Capital preservation is the sacred rule that makes everything else possible. Never risk more than 1 to 2% of account equity per trade. Always use a hard stop loss and never move it further from entry. And calculate your position size precisely using dollar risk divided by pip risk. The chart tells the story clearly. Risking 10% per trade can destroy 65% of your account across 10 losing trades, a hole requiring a 300% gain to escape, while 2% risk leaves you down only 18%, easily recoverable. Keep a rigorous trading journal to track the clinical history of every decision. A trading system is a clinical protocol. It exists to protect you from the fatal just this once impulse. Begin by assessing market structure. Is the instrument trending or ranging, and are higher time frames aligned? Identify your setup, breakout, pullback, or reversal. And remember, if you have to squint, it's not there. Wait for an objective entry trigger with no intuition allowed. Place your stop loss exactly where your diagnostic analysis is proven wrong, and only take the trade if the risk-to-reward ratio is at least 1 to 2. If not, abort. True financial sovereignty rests on 4 pillars that must operate in clinical harmony. Economic philosophy provides the foundation, understanding human action and the business cycle. Institutional infrastructure means operating in a sterile STP/ECN liquidity environment. Technical interpretation means reading price action and volume without indicator noise. And psychological discipline means mastering fear and ego through clinical protocols. Technical skill without economic philosophy is hollow. Psychological discipline without institutional infrastructure is futile. All 4 must work together. You are not a gambler. You are an entrepreneur. You are not a victim of the economy. You are a participant in price discovery. You are not your emotions. You are the clinical observer of your psychology. The vital signs are in front of you, the chart is your patient, and the markets are open. You are a free trader operating in a free market, building a free life. Open your charts and begin.